What's going on, you guys? I hope you are having a fantastic day. Today we're going to be talking about the best dividend stocks for 2018. Now, some of you may be noticing that I'm using a whiteboard here, and those of you that have been following my channel for a long time know that I used to have my old whiteboard set up. It's actually still back here behind my black backdrop. But for the issue of trying to light the board, I had a very hard time with that. But I'm going to use this whiteboard probably for most of my videos going forward because I still have a lot of markers and it's not wasting all that paper with the other pads of paper that I use. But if for whatever reason you guys have an issue with this and you prefer the pad and paper, let me know in the comments. I'm totally fine with doing either one of those two things. But we're going to cover the top 3 dividend picks I have for 2018. And now I also want to thank you guys, those of you that have joined my new stock analysis membership site, Stock Radar. My goal was to get 100 members in there by the end of this month, and we've already reached 106, so that is absolutely amazing. You guys can get into that group right now. The actual sale for that ends on Thursday at 11:55 p.m. Eastern Standard Time, and I have a big reason that you guys should join right now that might interest you, is I just added an entire course to this group on fundamental stock analysis. It's a 10-part course talking all about how to value a company's stock and how to conduct fundamental analysis of a company. And I'm also going to be adding an entire course on bear market investing strategies, and I'm going to be bringing on an expert in technical stock analysis and maybe down the road somebody who is an expert in options. I'm going to be having all kinds of extra bonus material and courses within this. You guys are not going to want to miss out on that. Now, the price of this membership is going to increase with time, so if this does interest you, you might want to get in while it's cheap. But because we're talking about dividend stocks today, I want to give you guys a free preview of that new course on Fundamental Stock Analysis 101. So this is going to give us a good background on how to analyze dividend stocks, and we're going to be talking about the dividend coverage ratio of these stocks. So I just want you guys to have a little bit of background information on that. So here is a preview of Fundamental Stock Analysis 101, a free course available to you in Stock Radar. How's it going today, guys? Welcome back to Fundamental Stock Analysis 101, and in this video we're going to be talking about the dividend. Now I want to start out by pointing out the typical growth rate of a company, and it looks very similar to this curve here. So when a company starts out and when they're a new company, they're going to grow at a much faster rate than they're going to grow in the future, and as a result you're going to see that growth begin to taper off going forward. So this is what companies do when they're in this zone here, when they're growing at a much slower rate or they're just consistent with their operations. What they do is they pay dividends as a way to reward shareholders and keep them around. Now, dividends are quarterly cash payments, and they're sharing their earnings with the shareholders. So if they're earning a lot of money, they have a lot of earnings per share, they might make the decision to pay shareholders a quarterly dividend. Now, we talk about the dividend quite a bit here in Stock Radar. We talk about the dividend history, how long this company has been paying that dividend, the dividend growth streak, so how many years has that dividend been growing, and we also talk about the dividend yield, or how much they are paying to shareholders. So just understand that when a company is in income mode, when a lot of the growth has already happened and they're growing at a much slower rate, or they just have consistent or flat growth, they're going to become an income investment because they are likely going to reward shareholders with dividends. But a company that is in growth mode, if they're trying to grow as fast as possible, they're not going to pay dividends. They're going to be reinvesting those earnings into the growth of the company. So we used AT&T as an example of an income investment. They pay dividends to shareholders because they are not growing very fast. And Amazon is a growth stock because they are reinvesting all of the earnings to grow the company as fast as possible, and as a result they don't pay a dividend. So Amazon is still down here on this curve where they're growing very rapidly, while AT&T is further along in this curve where they're pretty much flat with very little growth going on, and as a result AT&T is paying dividends to reward shareholders and give them a reason to stick around, because if you guys saw that video here on Stock Radar, the stock has had very lackluster performance, and there's not much there being offered other than that very high dividend. So how do you actually calculate the dividend a company pays? What you do is you take the annual dividends paid out divided by the market price, and that's going to give you the dividend yield. And again, all you have to do is do a search for a stock on Google, and it's going to show you the dividend yield right on that chart. But that's how you go about calculating it. So let's calculate the dividend yield for AT&T. Over the last 4 quarters, they've paid a 49-cent dividend. So we take 49 cents times 4 and divide it by the market price of $37.16. And that gives us a dividend yield of 5.3%. So what kind of dividend yield should you be looking for as an investor if you're looking for an income investment? Well, the S&P 500 average dividend is around 2.2%, but if you're looking for an income investment and you're not focused on growth, a good number to look for is between 3 to 6. So AT&T falls in there. They have a 5.3, a very good dividend, but they have no growth potential pretty much. I mean, the growth has been non-existent over the last 5 years. So that's the issue that you have there. You have to weigh the pros and cons. Are you looking for a high dividend with low growth or no dividend with higher growth? That's what you have to decide as an investor, is what you are looking for. Now, another very important thing to consider is whether or not a company can afford to pay a dividend, because high dividends are great, but understand that dividends are not guaranteed and they can cut or discontinue a dividend at any time. A perfect example of this is General Electric. They had to slash that dividend because they simply could not afford to pay that dividend, and they still can't afford to pay the dividend even now. So the future for them is uncertain. They may have to cut the dividend again. But anyways, the way you calculate that is by looking at the dividend coverage ratio. And this is very simple to figure out, and this might be something you have to calculate on your own because I have yet to find a resource that does this for you. But all you do is you take the annual earnings per share and divide it by the annual dividend per share, and that gives you an idea of how much of the earnings they are passing along to shareholders and how much of the earnings they are keeping for themselves. So basically, let's go ahead and calculate this for AT&T, looking at the fiscal 2017 year numbers. So for fiscal year 2017, AT&T had earnings of $4.76, and they paid out $1.97 of dividends, giving them a dividend coverage ratio of 2.4. So what exactly does that mean? Here's what it means. If the dividend coverage ratio is below 1, that means they are paying out more in dividends than they are earning. That was the case with General Electric, and as a result, that is very bad. That means they are likely going to have to restructure or cut that dividend. Now, if the dividend coverage ratio is between a 1 to a 1.5, they don't have great coverage of that dividend, and they will likely be cutting it or restructuring it in the future. The optimal zone to be in is between a 2 and a 3, and as we can see, AT&T came in at a 2.4, so they're right where they need to be. So when you're looking for a dividend coverage ratio, I always look for a dividend coverage ratio between 2 and 3. But on the other side of the coin, if the dividend coverage ratio is above 3, that means the company is retaining most of those earnings and they may be being greedy. So what I look for is a dividend coverage ratio between 2 and 3. If it's below a 1.5, I don't think that is investment worthy. And if it's above 3, then you want to make sure that company is reinvesting earnings and not just retaining them for themselves. Anyways, guys, that's going to wrap up this video. Just for a recap here, we talked about how companies typically grow faster at the inception and grow at a slower rate going forward, and how income investments pay dividends, while growth investments, what they are doing is reinvesting the earnings into the growth of the company. We talked about how to calculate the dividend yield. We looked at the average rate of the S&P 500 and said a good dividend to look for is between 3 and 6%. And then we talked about the importance of the dividend coverage ratio and why you need to make sure a company can afford to pay the dividend they are paying to shareholders. And we talked about those numbers right here, and the optimal range for what I look for is between a 2 and a 3. But that's all I got for this video, and I hope to see you in the next one. Okay guys, so I hope you enjoyed that free preview of Fundamental Stock Analysis 101. The other 9 parts are sitting there waiting for you right in Stock Radar if you're interested. But now that we have some background on what we're looking for with dividend investments, I want to go ahead and talk about my top 3 picks for 2018. Now, I actually started with a list of about 15 high dividend stocks, and what I went through is I went through and looked at that dividend coverage ratio, which we just learned about, and that is something that is very important, and a lot of people don't consider this, is whether or not a company can actually afford to pay a dividend. Of course, high dividends are great, and we all want to invest in high dividend investments, but the number one question you should ask is, can this company actually afford to pay it? So in my opinion, all 3 of these companies have a very safe dividend, and they all have a good ability to pay that dividend to shareholders. And the thing about dividend investments is, if you're looking for a pure income investment, it should be very boring. And these are 3 of the most boring companies that you can think of. It's AT&T, it's Pfizer, and then it is Kimberly-Clark. And I have very high confidence in these 3 dividend stocks as far as their consistency and their ability to pay that dividend to shareholders. So number 1 on my list here is AT&T. It's a stock we've already covered over in Stock Radar. They have a dividend of 5.4%, and they have a dividend coverage ratio of 2.4. Like I said, above 1.5 is acceptable, but I'm looking for a dividend coverage ratio between 2 and 3. Now, as far as that dividend goes, they've been paying that dividend to shareholders for 34 years, and they have a 34-year growth streak of that dividend. AT&T is the world's largest telecommunications company. They have a very favorable business model for income investors because it is subscription-based, whether it's through their data subscriptions for their cell phones or the internet plans they offer, or maybe it's through the DirecTV subscriptions because AT&T does own DirecTV. That subscription business model is very consistent and predictable, and so it's great for an income investment. It gives AT&T a lot of free cash flow. Now, there is one downside to this investment, is that at this point in time, AT&T is solely an income investment. Over the last 5 years, this stock has returned just 4% to shareholders, so there's absolutely no growth with that stock over the last 5 years. All they are really offering is that hefty dividend of 5.4%. But that being said, I would say AT&T has one of the safest dividends out there due to that subscription-based business model and their amazing track record of paying and growing dividends. Now, number 2 on my list is going to be Pfizer. They have a dividend of 3.7%. Their dividend coverage ratio is actually better than AT&T's at a 2.7, and they have been paying dividends for 38 years. They had to cut them back in 2009, but since 2009, they've grown that dividend every single year, so they have a 9-year dividend growth streak. The reason why I like Pfizer as an income investment is because this is a recession-proof industry. This is a pharmaceutical company. They're making pharmaceutical drugs that are saving people's lives or keeping them alive. And so no matter what, these people are going to be buying these drugs, whether or not they are in a good economy or a bad economy. So we could argue that maybe in a bad economy, people are not going to be spending as much money on travel and dining, but they are sure as hell going to be paying their money to Pfizer in the form of their prescription drugs. People are going to buy the drugs no matter what the economy is doing. And for a good, reliable income investment, that is what you want to see. You want to see a recession-proof industry. And the other thing that is great about Pfizer is there is very high research and development costs associated with pharmaceutical drugs, which gives them very high barriers to entry. The other plus for Pfizer is the fact that they have had pretty decent growth over the last 5 years. They're up 34.4% over the last 5 years, and that is why they are my number 2 pick here as far as dividend investments for 2018. And number 3 on my list is Kimberly-Clark. They pay a dividend of 3.5%, and their dividend coverage ratio is 1.6%. Now, like I said, I like to see one between 2 and 3, but as long as it's above 1.5, that usually means that company can afford to pay that dividend, and they will likely not be restructuring it. Now, Kimberly-Clark has been paying a dividend for 46 years, and they have grown that dividend in all of those years. They have the longest dividend history and longest dividend growth streak of any of these picks right here. And the reason why I like Kimberly-Clark is because they are in the consumer staples industry. They are producing everyday essentials, things we are using every single day, no matter what. And a lot of people don't realize what brands Kimberly-Clark owns, and I'm going to tell you guys what those are right now. So the main brands under Kimberly-Clark are Kotex, you have Kleenex, you have Cottonelle, you have Huggies, and you also have Depend. And then on top of that, you can add Scott. There's the Scott paper towels and the Scott toilet paper. There's all kinds of paper products and all kinds of these household names that Kimberly-Clark owns. So Kimberly-Clark is one of the largest manufacturers of paper and hygiene products. We're using these things every single day. I'm going to take a guess that even if you didn't have the money, you're still going to buy paper towels and napkins and toilet paper and other products like that. I mean, these are things we need no matter what. That is what I like about Kimberly-Clark, and that is why I see this as a very safe dividend investment. So over the last 5 years, Kimberly-Clark has returned 24.9%, and the other plus for Kimberly-Clark is the fact that they have global exposure. They do about half of their sales in North America, and the other half are international. So they're diversified across different markets. This just makes them a very, very safe and consistent investment, and that is why they belong here on my top 3 dividend picks for 2018. Anyways, guys, that is all I got for this video. Let me know what you guys think of these picks in the comments section below, and what dividend stocks are you investing in? Do you have any of the picks listed here, or do you have different ones entirely? But again, guys, just keep in mind I do have that 10-part course on fundamental stock analysis waiting for you right now over in Stock Radar if you guys want to join. That discount ends Thursday at 11:55 p.m. Eastern Standard Time, and that membership price is going to go up for good. But I thank you guys for taking the time to watch this video, and I hope you have a great rest of your day. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.